In this video I teach you how to record income taxes.
I'm Carsten Berkau, full accounting professor in Osnabrück. My BasicsClips will help you to understand international bookkeeping.
The case is taken from chapter 11 of the textbook. We refer to the case study PELZERHAGEN Limited. We assume that the company prepared already a profit and loss account. This means that the pre-tax profit is already known. PELZERHAGEN Limited is established by $100,000. Furthermore, we have to consider a few bookkeeping entries. One of them is for rent to the extent of $3,400. The next one is for the salary, $48,000. The acquisition of equipment, $50,000, which is on credit, and depreciation. The company will earn a revenue to the extent of $130,000. Taking this into account, we arrive at the profit and loss account for 2007. You will see revenue $130,000 on the credit side, and on the debit side we get the expenses for labor, depreciation and rent. In total, the pre-tax profit is $68,600. The formula for the income tax expenses is earnings before taxes multiplied with the tax rate. So write income tax expenses equals earnings before taxes multiplied with the income tax rate. So in our case, the income tax rate is always 30%. Now, in order to get the earnings before taxes, we have to prepare a profit and loss account. We record revenue and all the expenses as known so far. We must balance off the account. Now we know that the earnings before taxes will be $68,600. And that gives us income tax expenses to the extent of $20,580. We record this straight in the profit and loss account. As we enter in the profit and loss account the 3-digit code for the contra account, it will appear as income tax liabilities. And we make the credit entry in the income tax liabilities account. Reference here will be profit and loss $20,580. The annual surplus, which is the profit after taxes, will be transferred to the retained earnings account. This is why you find in the profit and loss account the reference retained earnings. Here it is 48,020. And we make a credit entry in the retained earnings account. The profit and loss account will be zero balanced. For the profit calculation, we only need the nominal accounts. In this case of PELZERHAGEN Proprietary Limited, that will be the labor account, the rent account, depreciation and revenue. I recorded already the bookkeeping entries and balanced off the accounts. Next, we close off the nominal accounts to profit and loss. After recording the profit and loss account, I balance it off. As long as we only balance off an account, no other account will be involved. The income taxes will be transferred to the income tax liabilities account. That's the reason why the entry is income tax liabilities, and here the value is $20,580. Earnings after taxes will be transferred to equity. Here it is the retained earnings account. We make a debit entry in the profit and loss account. We make a credit entry in the retained earnings account. Next, we prepare an income statement for PELZERHAGEN Proprietary Limited for the year 2007. The reporting currency is the Australian dollar. We enter the values for the revenue, which is $130,000. There is no further income. We don't have any materials. We record labor to the extent of $48,000. We got depreciation $10,000, and other expenses is here for rent. It is $3,400. Now the income statement template calculates everything already, so we don't have to make any further entry. The earnings after taxes will be transferred to the retained earnings account and will appear on the balance sheet. Income tax expenses will be shown as income tax liabilities on the balance sheet as well. On the balance sheet, we record the item retained earnings, which gives us here 48,020. And there's another item which is for income tax liabilities, where we enter the value of 20,580. Note, under income tax liabilities you cannot disclose value-added tax. Value-added tax is just a short-term liability and will be recorded under AP. If the company makes a loss, the entry for the retained earnings account will be in the profit and loss account on the credit side, and we make a debit entry in retained earnings. In this case, no taxes apply. We replace on the profit and loss account the value of 130,000 by 50,000. In this case, the earnings before taxes become negative, which means once we balance off the account, they will appear on the credit side. We will refer to them as a net loss. The net loss is 61,400 less 50,000. Now we do not make any bookkeeping entry for income taxes as they don't apply. We record the entry for retained earnings on the debit side of the retained earnings account. On the income statement, we change the 130,000 to 50,000 to get the other situation, and we see instantly that the earnings before taxes will be negative, so the taxes will be zero. Income taxes will only be calculated once the earnings before taxes are positive, otherwise they will be zero. On its balance sheet, the item for cash bank will be lowered to the extent of 80,000, as the company did not cash in a revenue of 130,000 but of 50,000. The difference is 80,000, which I deducted from cash bank. That gives me 98,600. On the credit side, I enter the value for the loss, which is 11,400. As you can see, the total on the debit side equals the total on the credit side. Now that you have seen the video, take the textbook and study the case.